It was a tumultuous quarter and a pretty eventful week as well. What are we learning from all this?
Clearly, the inversion of the yield curve, which a couple of days ago it happened briefly intraday and didn't close at that level, has, I think, garnered most of the attention, certainly a lot of the financial media attention, and lots of confusion about what it actually says about the risk of recession. I think anytime you have an inversion, anytime you've got a Fed moving from extremely easy policy to tighter policy, you need to dust off the checklist for a recession. But to see the market behave somewhat resiliency is actually not out of the ordinary. Yield curve inversions have historically generally seen rising equity markets. It's really not until the point where recession seems like a higher likelihood do you run into trouble. But I think we're in a relief rally relative to the correction that preceded it. I wouldn't bank on it continuing without another bit of a pullback.
Sarah, do you believe the relief rally? Is it here to stay?
It all depends, David, on what real interest rates do. So it's very important to note that as inflation is rising, we are seeing, and this is particularly acutely an issue in Europe and in the US, real interest rates are going more negative, and that creates more fuel for equity buying. So that's one of the reasons why we keep fully invested, because we want to make sure our clients get access to what the only place you can put money is in equity markets, in our view. And also note, I mean, there's plenty of bad news, but oil price shocks historically in the 70s, early 90s, in 2000, they're not always followed by weak equity markets. Those two are not correlated. So there are reasons to be optimistic in what looks like a very dark environment.
So, Liz Ann, I wonder, in the face of these negative real rates that we just heard about from Sarah, as well as oil shocks at the moment, there's a lot of talk about the 70s, where we had overstimulus, and then on top of that, the oil shocks. It really does raise the question about the inflation. Negative real rates indicate we still have our foot on the accelerator, not the brake. How far do we have to go to slow down this economy to get inflation under control?
Well, you know, even Powell has said he's willing to accept a recession as the end game associated with finally bringing down this inflation problem. I don't think we're really looking at a 70s type of environment. I think there's more differences between today and the 1970s than there are similarities. Stagflation, I think, used with a lowercase s generically, maybe is appropriate given weaker growth and high inflation. But really what that represented in the 70s was a high and rising unemployment rate, which is clearly different than the current environment. In addition, we have much stronger productivity now. Demographics are different, obviously unionization. So I think the type of inflation we're experiencing now is more of the counter-cyclical variety, where inflation went from being pro-cyclical, strong demand last year helped bring on inflation, and now inflation is to such a high level that it's starting to put downward pressure on demand and growth. So maybe it's just semantics of what we call this inflation, but I don't quite think that this is the 1970s.
But David, what we do know is that central banks have to do something about it. And that's what makes this interesting, because we are moving through a real economic cycle. And to what degree will some of this inflation self-correct? To what degree will supply chains come out of their difficulties and do so somewhat organically? I think that's very debatable. It's something we, in terms of investment research, we're not giving credit for that. We just assume that some of these bottlenecks are going to remain for many quarters ahead, in which case central banks have to cool demand. And that in turn is going to likely create some significant slowing of economies, which and all the more shores up the reasons to have great companies in your portfolio, because there's some headwinds ahead.
Yeah, I think there has to be a focus on quality right now. The relief rally had a bit of a low quality bias to it, but I wouldn't bet on that persisting. I think the focus for the stock pickers out there needs to have that quality wrapper around it at this point in the cycle.
So, Liz Ann, explain quality to me a little bit. Is that, for example, is that value versus growth? Is it large cap, small cap? What do you look to for quality?
We think you want to take from a factor perspective, a hybrid between value and growth. I'm not talking about the value and growth indexes. That really ultimately is you're making a sector call. I'm talking about the fundamentals of value and growth. And what tends to happen when you're in a slowing economy you tend to want to look for areas that are displaying what is lacking in the economy. So as growth slows, companies that have the ability to grow their earnings tend to do better. In a rising interest rate environment, that puts downward pressure on long duration, more richly valued areas. So you want to have that value filter. We're now in an environment where there's more negative revisions to earnings than positive. So you want to look for areas and companies that have positive earnings revisions. Again, rising interest rates, low debt to equity ratio. So I think this is an environment where you want to be more factor focused than style box focused or even sector focused.
And markets are such extraordinary discounting mechanisms. They look ahead and anticipate. And so that's why it might be a little late to be piling in more to energy and metals and mining that have had just incredible run. And we like to look where others aren't. And there are definitely segments where companies can pass on some of this cost increase, in some cases, all of it. And those are remarkable businesses to be in an inflationary environment. And they're out there, often priced at lower valuations than the overall market.
Liz Ann, are earnings going to bail us out?
Well, earnings should still be in positive territory, but we've been in a descending pattern since the second quarter of last year. That was inevitable. You had almost 100% S&P earnings growth in the second quarter of last year because of the base effect relative to the year prior. That descended to about 32% in the fourth quarter, but we're now down in the mid-single digit range. Now, we may find again that analysts have set the bar too low, but we've been in a descending rate from a beat rate perspective and a lower percent by which companies are beating. And as I already mentioned, you've got that trend of now more negative earnings revisions than positive. So I think we're on the cusp of a more difficult period. I think what will be more important in this reporting season about to start is less about what was reported for the first quarter, but the combination of outlooks broadly, but specifically around profit margins and the ability to maintain those profit margins in light of rising labor costs as well as rising input costs in other areas.
Sarah, what are you expecting from earnings?
Well, in terms of market cap weighted, you obviously have to look at some of the big constituents, and it's somewhat of a mixed bag. It really, some of that depends, especially for the internet stocks, on what happens to advertising. A stock like Alphabet is interesting to us, and obviously a giant in the US market, because they have some of their ads, a good portion of them, that are related to travel and leisure. And we see that recovering. If you've been through any airports lately, they're mobbed. And just look at the online searches for travel, both domestic and international. It's going crazy. So there's obviously a lot of pent up demand, and it's somewhat debatable to what degree inflation will crimp that spending. And that ought to be good for some of the big caps like Alphabet, not to mention their cloud business, et cetera. So I think it's somewhat hard to say. What we can say is those companies that were achieving record profit margins are likely to see, I mean, it's hard to make generalizations, but they're going to have a little bit of a struggle. That we might have seen the peak there for some time.
Yeah, it sounds like.
And Sarah, to your point about, pent up demand on the services side, one of the potential benefits to bringing inflation down is we're starting to see some pent down demand on the goods side. And clearly at the core level of inflation, much of that was driven by the goods side of the economy. And we are starting to see some weaker numbers, in large part because whether it's wage data, consumption data, retail sales, you look at the difference between nominal and real. And unfortunately, in instances like wage growth, lofty numbers in nominal terms, but still in negative territory from a real perspective.
Yeah, we saw that actually on Friday, actually, where that was 5.6% up in wages year over year. But in fact, if you take into account inflation, they actually lost some money in terms of purchasing power.